I have no idea the last time you saw this type of a market move off of a weekly jobless claims number. And I'm not just talking about in the equity space, but you even see that reflected in fixed income as well. Were you up trading this morning?
Well, you make a good point. It is significant to know when there's a hypersensitive market move to a really mundane number. It tells you that things are really precarious. Otherwise, it would never have done anything like that. What we have done to take advantage of this change in volatility is just use some derivatives. So we have a certain group of portfolios or strategies that where we hedge the duration. Mm-hmm. We use that with Treasury futures or options on futures. And the options, flipping between the two is really beneficial when vol changes. So when things are calm, like today's a calm day, you add some options knowing that, just as you mentioned earlier, just wait an hour, wait a day, and there'll be another surprise in an overreaction to another mundane number like claims. Then after that VIX or that vol spikes, then we just flip right back into the futures.
How confident are you? I mean, just based on everything that's transpired let's just say over the last couple of weeks, coming out of those earnings last week, the jobs report on Friday, and everything that's transpired this week, did that give you any confidence in extending duration, or did it have the opposite effect?
The main thing that the last 2 weeks worth of data has done for us is convince us that the curve is going to normalize. So we think that the Fed is going to steadily move towards lower rates. Don't know exactly how far, what the magnitude is going to be, but we just need to know the direction. And what that's going to do is it's going to mean that you want to be positioned in the middle of the yield curve. The 3 to 6 year will be the best part. The 30 year is going to be pretty precarious. It's not done well over the last year. Yields are actually up on the 30 year, where everything else is the same or lower. So that's what's really convinced us is a sustainable trend, a sustainable normalization of the curve in the last 2 weeks.
So what does that then, Bryce, mean for the corporate credit market, right? Like, it doesn't feel like the corporate credit market has responded in the same way that the Treasury market has, or even the VIX has, to whatever kind of volatility spike and growth scare that we're looking at.
Yes, for sure. The corporate bond market has yield buyers. There's a whole generation of bond investors who have forgotten what that even means. When yields get to a certain height or point, people are like, hey, for that company, for that BBB rated company, I need 6% yield to compensate me for that 10-year default risk. Treasury yields could be 4, they could be 5, they can be whatever. And the yield buyer will be, I still need 6%. So Treasury yields might fall and corporate bonds won't keep up. Because if anything, the decline in Treasury yields is happening because of a fear of worsening economic conditions. That's not good for default rates. So what we're doing in the belly of the curve is we're lightening up on corporates because they're going to underperform. They won't keep up. And we're going to more of government agency mortgage type securities, specifically ones that will do really well if mortgage rates come down and prepayments pick up. We think that those are going to add a lot more return, as well as protect you from downside against default risk.
So does that setup imply that we're going to be headed toward a recession, or increasing recession odds, or just decreasing the Goldilocks soft landing scenario?
What makes the difference for us in terms of whether there's going to be a recession or not is credit and credit availability. Banks were tightening credit like mad a year ago, March, when banks were failing. Yields coming down has bought them time, given them breathing room. Their loans are not so underwater now. So from a capital constrained perspective, it's not as bad. Ironically, as the consumer struggles, and they are, banks will actually be easing up on credit. They'll be allowing more credit. I don't think I've ever seen that happen in a down cycle before. But it might be just enough to keep us from going into a full-blown recession, because it's a credit crunch that really puts an economy over the edge. And we don't see that happening this time.